Hey everyone, and welcome to this explainer. Today, we're decoding what is honestly the most essential language in the world, the language of business. We're going to break down the absolute foundation of accounting. You know, those structural building blocks that literally every successful organization relies on to scale. And look, this isn't just about crunching numbers. It's an incredibly powerful mental model for understanding exactly how value flows. So let's start unlocking these concepts together, shall we? Imagine for a second that you're running your own business. You've got clients, you're buying supplies, moving inventory, the whole shebang. But do you know with absolute certainty how the money is actually moving? More importantly, do you know if you're genuinely making a profit or just secretly bleeding cash behind the scenes? Without a structured way to track all this financial activity, you're essentially flying blind. True visibility, knowing the exact path of every single dollar, well, that's exactly what separates a surviving business from a thriving one. So here's our roadmap for today. We'll cover the language of business, demystifying debit and credit, the master accounting equation, putting it into practice, and finally, your financial golden rules. Okay, let's dive into this. Section 1, the language of business, or what exactly is accounting? Whenever you hear the word accounting, just keep this definition in mind. It's the systematic process of recording, classifying, summarizing, and interpreting financial transactions. Notice that word systematic. This isn't just randomly jotting down numbers on a napkin over lunch, right? It's a highly organized method. In the simplest possible terms, accounting is the foundational language that shows exactly how money moves in and out of any organization. Whether a business is buying goods, selling products, paying salaries, or receiving payments, accounting is the system that captures that activity, organizes it, and gives you the final financial result. So, why does this language actually matter to you? Well, it serves four absolutely vital purposes. First, it tracks money, so you know exactly what's coming in and going out. Second, it measures performance, telling you definitively if you're operating at a profit or a loss. Third, it supports critical decision-making, like say you're wondering if you can afford to expand to a new location or hire more staff. Accounting holds the answer. And finally, it ensures you meet legal and tax requirements by keeping your financial records straight. Nobody wants to mess with a tax man, for sure. Moving on to Section 2, we're demystifying debit and credit, focusing on the directions of money. Okay, every single transaction in accounting uses a debit and a credit. And please, listen closely to this part because it trips up so many people. Debit is not good and credit is not bad. They actually come from the Latin words debere, meaning to owe, and credere, meaning to entrust. In business, there's strictly directional instructions. That's it. Debit, which we abbreviate as DR, literally just means the left side of an account and usually represents an increase in your assets or expenses. Credit, or CR, just means the right side of an account, representing an increase in your liabilities, income, or capital. Left and right. Nothing more, nothing less. Think of a business like a container of money. Picture a physical bucket in front of you. When value comes into that container and an asset increases, boom, it's recorded as a debit. On the flip side, when value goes out of that container, meaning an asset decreases or your obligation to pay someone else increases, that is recorded as a credit. They are just the accounting directions telling you which way the value is flowing through your business bucket. All right, Section 3, the master accounting equation, also known as a golden rule. Now, what's really interesting about this slide is this simple formula right here. Assets equals liabilities plus equity. This is hands down the most important equation in all of accounting. It's the absolute heart of what we call the double entry system, because every financial event has at least one debit entry and at least one credit entry. Both sides of this equation must always be equal. It literally never breaks. So let's break down exactly what these three crucial terms mean. Starting with assets. Put simply, assets are everything the business owns. If it has value, it's an asset. This includes the cold hard cash sitting in your bank account, the physical buildings you operate out of, the equipment you use to manufacture goods, the inventory sitting on your shelves just waiting to be sold, and, even the vehicles your company uses. Basically, these are your resources. Now, on the other side of the equal sign, we have liabilities. Liabilities are what the business owes to others. It's borrowed money. Say you took out a bank loan to get your operations off the ground. That loan is a liability. If you purchased a bunch of supplies on credit and haven't paid the invoice yet, those unpaid bills are liabilities too. They are your debts and your financial obligations to the outside world. And finally, we have equity. Equity is the owner's share in the business. You see, a business is always financed in one of two ways, either by borrowed money, which we just defined as liabilities, or by the owner's own investment, which is equity. Mathematically, it's whatever remains after you subtract all your liabilities from your assets. It's the owner's money in the business. That's exactly why everything the business owns, the assets, must mathematically equal everything it owes to others plus the owner's share.
Let's speed things up a bit for Section 4, putting it into practice, the startup scenario.
Imagine you're starting a brand new design agency today. Exciting, right? You march down to the bank, open up a business account, and make your very first personal cash investment into the firm. You deposit exactly $1,000. Let's see exactly how accounting treats this event.
Let's move to and see how this builds step by step. Step 1, the business's cash increases, meaning an asset increases. At the same time, because you invested your own money, the owner's equity also increases. Step 2, we record a debit to cash for $1,000, representing that left side increase in our asset container. Then we record a credit to owner's equity for $1,000, representing the right side increase in the owner's claim. Step 3, we check the master equation. And look at that. On the left side, under assets, we have our $1,000 cash. On the right side, we have $0 in liabilities because, well, we haven't borrowed any money yet, plus $1,000 in equity. 1,000 equals 0 plus 1,000. Both sides are completely balanced, mathematically proving our double entry system works flawlessly. Now let's challenge ourselves with a second transaction. Your design agency is up and running, but you desperately need a high-end printer. So you go out and buy $300 worth of office equipment, paying for it using the cash your business already has. Let's look at the effects in step 1. Your equipment, which is an asset, increases by $300, but your cash, also an asset, decreases by $300. For step 2, the entry, we debit equipment for $300 to show the asset increase, and credit cash for $300 to show the asset decrease. Notice something kind of tricky here? Both the debit and the credit happened entirely on the asset side of the business. And this brilliantly illustrates the balance. Our total assets are still exactly $1,000. That $1,000 is now simply made up of $700 in remaining cash and $300 in new equipment. By swapping one asset for another, the total value on the left side hasn't changed at all. Our liabilities remain 0, and our equity remains $1,000. The equation remains perfectly, beautifully balanced.
All right, wrapping things up with Section 5, your financial golden rules and key takeaways. So, the crucial point is, I want you to walk away remembering these 4 pillars. First, accounting is the systematic way we track financial activities to make smart, informed decisions. Second, debit simply means the left side of the ledger, and credit simply means the right side. Third, because of double entry accounting, debits and credits must always be equal. And finally, the master equation. Assets equal liabilities plus equity is the ultimate foundation. Every single financial activity you will ever conduct affects this equation, but it will never, ever break it.
Now that you understand the basic language of business, here's my question for you. How will you apply this to your own financial container? If assets equal liabilities plus equity, what strategic moves are you going to make tomorrow to ensure your equity is actually growing? Keep tracking, keep balancing, and I'll see you in the next explainer.